Shanghai woke up, and silver didn't ask for permission. $102 per ounce, while the Western market sat at $86, completely unaware, or perhaps unwilling to move. A $10 premium, 188 million ounces of paper silver, heading into settlement with only half the physical metal available to back it. The options market is screaming at 134, manipulation accounts suspended, vaults draining, and yet the Western price hasn't blinked. Something is being held down. And when things that are held down finally let go, welcome. You're watching Jon Analyst, where the numbers speak first and the noise is left at the door. Now, before we go any further, if you haven't subscribed yet, think of it this way. You wouldn't cancel your morning newspaper after the most important headline of the decade finally lands on your doorstep, would you? Hit that subscribe button. Consider it your standing order, delivered every time the market has something real to say, and tell us, where in the world are you watching from today? Drop your city, your country, right there in the comments, because this story is bigger than one market, one city, or one time zone. And you're going to want to be here for all four parts of what comes next. Before the West had finished its morning coffee, Shanghai had already told the story, not in headlines, not in analyst reports, not in the carefully managed language of financial media, in numbers, raw, unfiltered, and impossible to misread for those who knew how to look. On the morning that changed the conversation, Shanghai silver futures opened at $99 per ounce. Western spot price going into that same open was sitting at $88.50. Two numbers, one commodity, and a gap between them wide enough to drive a freight train through. But to understand why that gap matters, why it is not simply a time zone arbitrage or a routine pricing discrepancy, you have to go back one step further, to the signal that arrived before the exchange even opened. Shenzhen recyclers, the physical market participants who process and trade real, tangible silver in one of the world's most active industrial demand centers, were placing bids running $5 or more above the SHFE pre-holiday close. This was not speculation. This was not positioning for a trade. This was the physical market declaring, in the only language markets truly speak, exactly where real demand was priced before a single futures contract changed hands. The informed minority was watching. The majority was not. When Shanghai opened, it did not drift higher. It surged. Futures pushed from $99 all the way to $100 per ounce within the session. And then, as the market absorbed the move, it closed at $96. Three numbers, open, high, close, each telling a different part of the same story. The open told you where physical demand had priced overnight pressure. The high told you where genuine buyers were willing to transact when the exchange gave them access. And the close, $96, told you something equally important, that above $100 there is real selling. Not just manipulation, not just paper suppression. Genuine participants with genuine positions who looked at $102 silver and decided that was a level worth reducing exposure at. Honest analysis requires holding both of those truths simultaneously. The surge was real. The resistance above $100 was also real. Markets are rarely one clean story. They are almost always two stories running in parallel. And the discipline is in reading both without letting one cancel out the other. Now consider what Western markets were doing during that entire Shanghai session. Volume was stalled, nearly flat, the kind of trading activity that, in any other context, would suggest a market simply waiting for a catalyst. But here, with Shanghai printing a $10 premium directly overhead, Western stagnation was not patience, it was disconnection. A structural separation between what the physical market in the East was pricing and what the paper market in the West was willing to acknowledge. That $10 in premium, Shanghai closing at $96 against Western spot at $86, is not a number to scroll past. For context, premiums of this magnitude between Eastern physical markets and Western futures prices have historically functioned as early warning indicators, not of what will happen tomorrow, but of what the physical market has already decided before the paper market has caught up. The paper market is, by design, a mechanism for price discovery. When the physical market begins pricing a commodity at a sustained and significant premium to the paper price, the mechanism is no longer functioning as designed. The gap between the two is not information. It is a warning. And the warning did not arrive quietly. Behind the opening numbers, behind the premium, behind the stalled Western volume, there was a deeper structural reality already in motion, one that had been building not for days, but for weeks. The physical demand signal from Shenzhen was not the beginning of this story. It was simply the moment the story became loud enough that ignoring it required deliberate effort. For the business community, for the serious capital allocator, for the entrepreneur who understands that macro signals arrive long before macro consequences, the Shanghai session was not a trading event. It was a structural disclosure. and the West, sitting quietly at $86, had not yet read it. There's an old principle in markets that most people learn too late. The paper price tells you what the market says silver is worth. The physical market tells you what someone is actually willing to pay to hold it in their hands tonight. When those two numbers match, the system is functioning. When they don't, the system is under pressure it is not yet admitted to. Right now, they don't match. And the pressure is not theoretical. It has a date attached to it, February 27th. Circle it, understand it. Because in the architecture of commodity, futures markets, first notice day is not a formality. It is the moment the clock stops being a concept and starts being a consequence. From February 27th onward, short positions on March silver futures can begin issuing delivery notices. Any long position still holding March contracts from that point forward is no longer trading paper. They are being assigned physical silver, real metal, warranted, vaulted, and ready for transfer. The roll window, the safe exit, closes on February 26th, one day earlier. That deadline is not in the future. It is now. As of Monday, March open interest on COMEX sat at 37,651 contracts. Each contract represents 5,000 ounces. Do the arithmetic, and the number that emerges is not comfortable. 188 million ounces of paper silver are moving toward settlement in 3 trading days. That is not a position. That is a structural concentration of delivery obligation pressing against a vault inventory that the data describes with uncomfortable precision. Registered COMEX silver, the metal that is warrant issued, physically located, and actually available for delivery, sits at approximately 88 million ounces. 188 million ounces of paper obligation. 88 million ounces of deliverable physical reality. 2 paper ounces for every 1 physical ounce that can actually be handed over. In any other context, in any warehouse, any supply chain, any business operating in the real economy, that ratio would trigger an immediate operational review. In the COMEX paper market, it has been described until very recently as normal market functioning. It is worth asking seriously whether that description still holds. The roll is underway. May open interest has increased as long positions move out of March, attempting to avoid the delivery window entirely. But the roll is not moving fast enough to eliminate the pressure. Not all March longs are rolling. Some are not rolling because they cannot. Some are not rolling because they will not. In a subset, the number that matters most and is watched most carefully by those tracking order flow may not be rolling because they intend to stand for delivery. If even a fraction of the remaining 188 million paper ounces attempts to convert into physical metal, the 88 million ounces available does not cover it. That is not speculation. That is subtraction. And then there's the vault data itself, because the inventory picture adds another layer to an already uncomfortable equation. Registered silver in COMEX vaults has remained essentially flat to slightly declining in recent days. No meaningful new metal is entering the registered category. No fresh warrants are being issued at a pace that would suggest the gap is being addressed. The drain continues, quietly, without announcement, without the kind of visible urgency that would alert a casual observer. But the serious observer is not casual, and the serious observer notes that a vault inventory that is not growing while delivery pressure is increasing is not a stable condition. It is a countdown expressed in ounces rather than seconds. Jim Rickards, writing in Currency Wars, described the moment physical commodity market stress becomes visible as the point where financial warfare stops being theoretical and starts being structural, where the paper construct, built to manage price perception, begins cracking under the weight of real-world demand that it was never designed to fully satisfy. That framework was written as history. Right now, between COMEX at $86 and Shanghai at $96, it reads like a calendar. There's one final signal in this picture that the informed minority is watching with particular discipline: the carry-adjusted basis between March and May futures. In a functioning market, futures contracts further out in time trade at a premium to nearby contracts, reflecting financing costs, storage costs, and time value. That condition is called contango. It is normal. It is expected. When that flips, when nearby silver trades above future silver, the condition is called backwardation. And backwardation in a physical commodity market carries exactly one meaning. I do not care what the paper price says. I need physical silver. Now, backwardation has not been confirmed yet, but the spread is narrowing and the vault is not filling, and February 27th is not waiting for anyone's permission to arrive. There is a particular kind of silence that experienced market observers have learned to distrust, not the silence of a slow market, not the silence of low activity or thin volume, but the silence of a price that is being held still while everything around it is screaming. That is the silence sitting over Western silver right now, and the instruments designed to measure what markets fear is coming are no longer whispering. They are at 134. The COMEX implied volatility index for silver options is not a number that casual market participants follow. It lives in the architecture of derivatives pricing, the layer of the market where serious institutional participants pay serious money to protect themselves against moves they believe are possible but not yet reflected in spot price. When that index sat below 100, it was elevated, noteworthy, worth monitoring. When it broke above 100, it was flagged in this analysis as a structural warning on the options market, beginning to price the possibility of disorderly movement that the spot price was not yet acknowledging. It is now at 134. To place that number in context, the last time implied volatility reached comparable levels was January 30th, when silver spiked to $120 per ounce. That move was violent, fast, and largely unexplained by mainstream financial media, which offered the usual vocabulary of momentum and speculative excess without examining the structural conditions underneath. The volatility index reached those levels during that spike. It is at 134 before any comparable move has occurred in the current cycle. The options market is not reacting to a price event. It is anticipating one. Understand what implied volatility actually measures, and the significance becomes impossible to dismiss. When institutional participants purchase silver options at elevated premiums, they are not making a directional bet in the conventional sense. They are paying, often at significant cost, to ensure that if the market moves violently in either direction, their exposure is defined and their losses are capped. The price of that protection is the implied volatility reading. At 134, the cost of that protection is extraordinary, which means the participants paying for it believe the probability of an extraordinary move is real enough to justify the premium. Both the SLV volatility index and silver futures options, implied volatility, are pointing in the same direction simultaneously. Two separate instruments, two separate measurement methodologies. One conclusion: sharp upside price risk is being priced into the market by the participants with the most sophisticated models, the largest capital bases, and the most to lose if they are wrong. The spot price at $86.40 has not moved to reflect any of this. A suppressed price and a screaming volatility index cannot occupy the same market indefinitely. One of them will be proven correct. And when institutional capital of this scale has already paid to be positioned for violent movement, the weight of evidence does not favor the side betting on continued stillness, but volatility data, however compelling, remains indirect evidence. It tells you what the market fears. It does not, by itself, tell you why the price is where it is rather than where the physical signals suggest it should be. For that, the SHFE provided something far more direct, something that removed the word theory from the conversation entirely. In February alone, the Shanghai Futures Exchange suspended 23 accounts for breaching trading rules. 23 in a single month. This is not a footnote. This is not a regulatory technicality buried in exchange filings that requires interpretation. The exchange itself, the institution responsible for maintaining the integrity of its own market, identified participants whose conduct violated its rules, documented their activity, and removed them from the market. On the specific session being examined in this analysis, heavy manipulation attempts at the SHFE open were visible in the order flow data, flagged in real time, documented by participants tracking the tape with the discipline and precision that serious market analysis requires. The exchange did not dispute the characterization, it suspended the accounts. When the institution running the market confirms, through its own enforcement actions, that manipulation was occurring at a scale requiring 23 separate account suspensions in 30 days, the question is no longer whether manipulation is happening. The question becomes far more important. Why here? Why now? And who benefits most from silver staying at $86 while Shanghai clears physical lots at $102? Those questions do not have simple answers, but they have directions. And the directions are visible in the data for anyone willing to look without the filter of a narrative they arrived with. The honest countercase, because serious analysis demands it, is this: implied volatility at 134 cuts in both directions. The same explosive potential that points toward violent upside can produce equally violent downside if a coordinated intervention, a margin call cascade, or a broader risk-off event forces simultaneous selling across asset classes. The Shanghai session itself demonstrated this duality. Silver opened at $90, hit $100, and closed at $96. It did not hold $100. Real selling pressure exists above that level, not just paper suppression, genuine participants reducing exposure at prices they consider stretched. Humphrey Neal, writing in Tape Reading and Market Tactics, observed that the tape tells you what is happening, not when it finishes happening. The volatility index is telling you something is happening. The 23 suspensions are telling you something has been happening. The $10 premium between Shanghai and Western Spot is telling you the physical market has already made its judgment. In Western Spot at $86.40, sitting below a resistance zone it has now rejected 3 times, with no forceful hourly body close above $89, is telling you the paper price has not yet agreed. 2 markets, 1 commodity, 1 volatility index at 134, 23 suspended accounts, and a clock running toward February 27th that does not care which market is right. It only cares which one is real. There's a particular kind of structural shift that does not announce itself. It does not arrive with a press conference. It does not appear in a mainstream headline until long after the move has already been made. It moves quietly, deliberately, and at a scale that only becomes visible in the data for those disciplined enough to read it without the distortion of a preferred conclusion. That shift is happening right now, and the silver market is not the origin of it. It is the symptom. Begin with oil. Because in the architecture of global macro, oil rarely moves in isolation, and when it moves on two separate signals simultaneously, the serious analyst does not treat it as coincidence. Crude oil has moved to $67 per barrel, the highest level recorded since August. Bullish positioning on oil is surging. The surface explanation circulating in commodity markets points toward geopolitical risk. Specifically, the question of whether current positioning is building ahead of a potential Iran escalation. That explanation is real, it is relevant, but it is incomplete. Beneath the geopolitical layer sits a structural supply reality that carries far longer and far heavier consequences than any single geopolitical event. Global oil discoveries have declined 40% over the past decade. Between 2015 and 2020, the world was finding an average of 10 billion barrels of new oil per year. Between 2021 and 2025, that number dropped to 6 billion barrels annually. This is not a pricing story. This is a geology and investment story, and it carries a 20-year lag before new exploration produces first output. What that means, translated into the language of macro consequence, is this. The structural supply problem visible in today's discovery data will not express itself fully in today's price. It will express itself in the price environment of the next decade. And the capital that understands this, the institutional capital, the sovereign capital, the patient capital that operates on decade-length time horizons rather than quarterly earnings cycles, is already positioning for that environment. When oil moves on both geopolitical risk and structural supply concern simultaneously, it does not simply add one inflationary input to the macro environment. It compounds the existing pressure already driving gold and silver higher. Energy costs are embedded in every stage of silver mining, refining, and transport. A structurally higher oil price floor is, by extension, a structurally higher silver production cost floor. The paper price at $86 has not priced this. The physical market in Shanghai, clearing lots at $102, may already be doing so. Now turn to gold, because gold is not moving in isolation either, and the numbers coming out of the East are no longer subtle. India has just confirmed another record month for gold imports. This is not an isolated data point to be noted and filed. It is the latest entry in a pattern that has been consistent, sustained, and deliberately underreported by Western financial media for months. Eastern physical demand for gold has been running at historically elevated levels across multiple consecutive quarters. The World Gold Council data confirms it. The Indian import numbers confirm it. The Chinese ETF flow data confirms it. And yet, gold is trading at $5,130 per ounce, while mainstream Western analysts reach for the vocabulary of bubbles, speculative excess, and momentum without examining the structural engine underneath the price. Here is what they are missing. The capital driving gold to $5,130 is not retail speculation. It is not momentum chasing. It is not the behavior of participants who discovered precious metals last quarter and are riding a trend they do not understand. It is institutional capital. It is sovereign capital. It is the deliberate, patient, and quietly executed judgment of buyers in Asia who have made a considered assessment about where real value resides in a global monetary system they no longer trust to manage their long-term interests. These are not emotional decisions. They are strategic ones, made by entities with research departments, with historical memory, with an understanding of what happens to paper-denominated wealth when the systems that underwrite it come under structural pressure. They are not buying because gold is going up. Gold is going up because they are buying. That distinction is not semantic. It is the entire story. And the Western analytical framework, still searching for a momentum catalyst or a narrative hook, has not found the language to describe it because the framework itself was built for a different era. Jim Rickards described this moment, not this specific week, but this specific condition, in Currency Wars as the point where the paper construct that normally manages price perception starts cracking under the weight of real-world demand it was never designed to fully satisfy. Between Shanghai at $96 and COMEX at $86, that crack is now visible without a microscope. Between gold at $5,130 and mainstream analysts calling it a bubble, the divergence between the paper narrative and the physical reality has reached a scale where the cost of being wrong for serious capital is no longer acceptable. The ones who verify the data understand this. The ones who rely on the narrative are still waiting for an explanation that fits the world they thought they were living in. Now, the honest rid. because this analysis does not end without one. The structural pressure described across these 4 parts is real, documented, and verifiable. The Shanghai premium is real. The COMEX settlement pressure is real. The volatility warning is real. The Eastern demand pattern is real. None of these conclusions require interpretation beyond what the data directly states. But the timeline is not written here. It is written by the market itself, on its own schedule, without regard for the elegance of any analytical framework, including this one. Shanghai closing at 96 does not automatically pull Western spot upward. It could mean Shanghai retreats toward Western levels if physical demand signals do not sustain. The backwardation signal has not confirmed. Registered vault inventory, while not growing, has not collapsed. The March roll is underway, and not every long will stand for delivery. Humphrey Neal's principle holds here as it has always held. The tape tells you what is happening, not when it finishes happening. Here is what the data is actually saying, stated plainly, without embellishment, for the serious decision maker this analysis is written for. Shanghai closed at $96 with a $10 premium to Western spot. The final physical lot cleared at $100. COMEX implied volatility sits at 134, the highest since the January spike to $120. 188 million ounces of paper silver are heading into settlement against 88 million ounces of deliverable physical metal. No new metal is entering COMEX vaults while the drain continues. India is printing record gold imports. The SHFE suspended 23 accounts for manipulation in a single month. The March to May spread is approaching a potential backwardation signal, and Western spot sits at $86.40. Below a resistance zone it has now rejected 3 times without a single forceful hourly body close above $89. The paper price and the physical market are not telling the same story. They have not been telling the same story for weeks. At some point, that gap resolves. For the business community watching this unfold, for the entrepreneur building capital in an environment where the macro signals are this concentrated and this directional. For the aspiring decision maker learning to read structure rather than react to noise, the question is not whether the gap between paper and physical closes. Gaps of this nature, built on structural foundations, this deep, always close. The question, the only question that carries practical weight for serious capital, is whether you read the data before the resolution, or after it. The ones who read it clearly, who separated what the data was saying from what they wanted it to say, who managed their capital with the same discipline they managed their analysis, those are the ones still standing when the dust settles. Verify the CME volatility data. Check the COMEX reports. Look at the open interest numbers. And when you do, read what is actually there. Not what you hoped would be. This has been Jon Analyst. The data was always speaking. The only question was who was listening.